Qualified Opportunity Funds and Opportunity Zones. That's the subject of today's ACTEC Trust and Estate Talk.
Welcome to ACTEC Trust and Estate Talk from the American College of Trust and Estate Counsel, a professional society of peer-elected trust and estate lawyers. This series offers professionals best practice advice, insights, and commentary on subjects that affect our profession and clients. To keep up with the changing world of wealth planning, subscribe at iTunes, Apple Podcasts, Stitcher, Google Play, or other podcast sites. And now, our ACTEC Fellow host with today's topic.
This is Travis Hayes, ACTEC Fellow from Naples, Florida. ACTEC filed a comment letter with the Treasury Department in June on qualified opportunity funds and opportunity zones, and the Treasury Department held a public hearing on the topic in July. For an update on this hot topic, you'll be hearing today from ACTEC Fellow Kevin Matz of New York City. Welcome to Kevin.
Well, thank you, Travis. Well, this is a very hot topic, and as you mentioned, Travis, ACTEC has in fact filed a comment letter with the Department of Treasury. In fact, it's filed 2 comment letters on each of the sets. We'll refer to them as tranches of proposed regulations that have been issued. Our focus through ACTEC is on trust and estate issues. So let me just set the table a little bit, and then we'll talk about the trust and estate issues that are presented that we commented on. And also what I'll do is I'll provide, because I had the opportunity, and it was a wonderful, wonderful experience, to provide testimony at the July 9th public hearing before Treasury. I'll also comment on the feedback that was received to the testimony that I provided on behalf of ACTEC. So qualified opportunity zones, what is that about? This is a creature of the 2017 Tax Act, the Tax Cuts and Jobs Act. And included in it, didn't get a lot of attention at the time, but included in it was this provision that's designed to promote investment in so-called economically distressed communities referred to as opportunity zones. And very interesting, this is the one provision of the Tax Cuts and Jobs Act that was bipartisan. It was supported, it's been supported, there's been a provision to this effect that has been searching for legislation to be included to going back a number of years, supported among others by Cory Booker, Democratic senator from New Jersey. There's also been a think tank supporting this, quite going back quite a ways, emanating from Silicon Valley, including Sean Parker, who was among the principals involved with that too. So it was included in the Tax Cuts and Jobs Act. Purpose, again, is to promote investment in economically distressed communities. And how does it do that? It does it in 3 ways. So basically, it says we're going to make these investments in these qualified opportunity funds very, very attractive by giving a troika of tax benefits. Number 1, you could defer your capital gain tax, the tax on the capital gains, if you happen to invest it within 180 days or deemed 180 days into the qualified opportunity fund, and you could defer it all the way until the earlier to occur of 2 dates. One is the sale or exchange of the interest in the qualified opportunity fund. And the second date, the outside date, and I sometimes will refer to it as a judgment date, is December 31, 2026. The earlier of sale or exchange, December 31, 2026. That's the number 1 first tax benefit. And again, that is without any interest charge whatsoever. So time value of money is enormous as far as the benefit provided. Secondly, some of the capital gains tax liability can actually disappear. You start at the way that the system works, it tracks everything through basis, and you start out with a 0 basis in the Qualified Opportunity Fund. If you happen to hold the interest in the Qualified Opportunity Fund for 5 years, you get a 10% step up in basis, which means 10% of the capital gains has disappeared. If you happen to hold it for 7 years, and that 7 years is prior to December 31, 2026, very importantly, to do that, you have to invest by December 31, 2019, under present law to make it 7 years by then, you get an additional 5% step up in basis. 10% plus 5% is 15% in the aggregate. That's 15% of the capital gain has disappeared. Thirdly, because the purpose of this program is to promote long-term investment in these economically distressed communities through these intermediary entities known as qualified opportunity funds, what Congress wants is a long-term investment structure. How do they encourage that? In addition to the 5-year and 7-year basis step-ups that can occur that I just mentioned, if you happen to hold the investment in the Qualified Opportunity Fund for 10 years, all subsequent appreciation is completely excluded from tax. Complete exclusion. So again, 3 benefits. Deferral, tax interest-free deferral, potentially until December 31, 2026. That's number one. Number two, you have the basis step-ups. 5-year hold, you get 10%. 7-year hold, you get another 5% to 15% to basically eliminate the capital gains that you have. And then thirdly, if you happen to hold the interest for 10 years and it appreciates in value, all that appreciation is completely excluded from tax. Now, the question I get sometimes is what happens if it goes down in value? There's a very taxpayer-friendly rule there too that says that if it goes down in value, and let's say December 31, 2026, the value has gone down, at that point in time, the amount of the inclusion is capped at the fair market value of the deferred gain, subject to further basis adjustments that may have occurred. So if you go down in value, you don't pay tax on the deferred gain amount. You pay tax on a lesser amount, and that is very significant. Trust in the estates world. How do we get interest in this? And how is this a focal point for us? Well, number one, I'll have clients who will call me not only about their estate planning, wills and trusts, and how to plan for that and what happens when they die, but they also say, what's this about this qualified opportunity funds, opportunity zones? Is it true that I can actually defer taxes to 2026? What's the catch there? And you go through it. You explain, yes, you can do that. There is no interest charge whatsoever. If you have a sale or exchange of the interest prior to then, that will be a triggering event. But otherwise, it's to December 31, 2026. You could maybe, because of the 5-year, 7-year holds, have 10 or 15% of the deferred gain disappear, and then any exclusions would be subject to complete exclusion if you happen to hold it for 10 years. But what could happen in the trust and estates world? Well, one thing that could happen is someone could die, right? And if death were to occur, the statute here, the enacting statute 1400Z-2, and also the second tranche proposed regulations that came out, they address that. And they say that statutorily, if you die, it's going to be considered income in respect of decedent under Section 691. Income in respect of decedent under Section 691, which means death is not going to be a taxable event, but it also preserves the deferred gain amount because when there's income in respect of decedent, 1014C of the Internal Revenue Code says there is no step up in basis. No step up in basis for IRD, for income in respect of decedent. So that's something to consider. Now, how could that be problematic? And how do we get concerned at the ACTEC level? And what motivated us to make a comment about this point? Well, what happens if someone under their estate plan says, well, I want to give an interest in the qualified opportunity fund to my nephew, okay? And I'm not giving my nephew any other cash. I'm just giving nephew, who actually isn't particularly well off, the interest in the qualified opportunity fund. Well, what happens come, quote unquote, judgment day, December 31, 2026, if the rich uncle has passed away first, okay, and hasn't separately provided a side fund? Because it is IRD, income in respect to decedent, no step up in basis, come December 31, 2026, that deferred tax becomes due. It may be 15% less as far as the gain to be included. There could be other adjustments over the course of time, depending on how the investment is structured, perhaps as a tax partnership. But that tax liability will become due, without regard to the fact that the nephew here may not have the cash on hand or the borrowing capacity to pay for the tax. That's a big problem. So we identified that in our comment letter, and our solution was there should be some sort of relief given. Now, at the hearing, the public hearing at Treasury, it was actually just outside Washington, D.C., on July 9th, we raised that. That was a point that I mentioned. And Treasury seemed to understand the issue. And one of the Treasury officials who was there said, well, how would this work? What if we were to have some sort of installment payment plan to allow for the payment of the tax over some period of time? My response was, that sounded like a great idea. So we'll see if the final regulations, and by the way, final regulations are promised for later this year, but let's see if the final regulations ultimately address that. But that seemed to indicate some receptiveness from Treasury. Now, what else could happen in the trust and estates world? How do we plan with assets, including potentially interest in qualified opportunity funds? Well, we could make gifts of the interest. We could make gifts outright to another person, or we could make gifts perhaps to a trust, including a grantor trust. What happens there? Well, if you look at the statute says two triggering events: sale or exchange, or judgment day, December 31, 2026. It doesn't say anything else. I would have thought that making a gift, unless perhaps you had debt in excess of basis, would not have been a taxable event. However, the second tranche proposed regulations didn't say that. They said to the contrary. They said that if you happen to make a gift and the gift is not to a grant or trust, that will be an event, an inclusion event, that will cause the deferred gain to then become taxable then. And I remember reading the proposed regs, the second tranche proposed regs, when they came out, first in their unofficial form in mid-April, ultimately were published in the Federal Register on May 1st, and saying, wow, that's not consistent with the statute. How are they getting that? So we took a look, our joint committee, we took a look at the preamble to the proposed regs that came out. And the preamble says, well, if you look at congressional history, the congressional record on this, it shows that Congress, even though the statute didn't say so, was concerned that gifts could be made. And unless the gift is to a grant or trust, the rationale being a grant or trust is the same taxpayer as a grantor, so that's a tax nothing. But if you make a gift and it's not to a grant or trust, that will be an inclusion event. So what did we do in our committee? We took a look very thoroughly through the congressional record, through the legislative history, and it didn't say that. There were some loose language that talked about changes in equity position and dispositions, but the preamble pieced together something that didn't seem to be there. So in our comment letter, we raised that point and said, most respectfully, statute doesn't say that, congressional record doesn't say that there's to be a clear change in existing principles under the tax law as to a gift not being a taxable event. At the Treasury hearing, I mentioned that again. The response that I received from the officials there, and again, this is all in the public record, was, okay, but how is there a mechanism to tax the event of somebody receiving a gift? Well, the answer to the positive, well, you tax a donee. It's not very different than the situation where someone dies and then the beneficiary gets taxed at some later date. You simply have a mechanism to tax a donee, so we'll see what happens there. Now, I mentioned that there was an exception to that, and that exception involved if you happen to have a transaction with a grant or trust. Grant or trust, again, are among our favorite vehicles in estate planning. They're treated under Revenue Ruling 85-13 as one and the same as a grantor. So the thought is you have a transaction with a grant or trust and it's a tax nothing as long as grant or trust status is maintained, including during the grantor's lifetime. But the actual language of the proposed regs was very interesting. It didn't talk about transactions with grant or trust. It talked about a contribution to a grant or trust. What's a contribution to a grant or trust, I ask? The preamble talks about not a contribution, talks about a gift. So it seems like it's talking about a gift. But in our estate planning, we love to have transactions with grant or trust that are beyond the scope of gifts. We love to sell the grant or trust, maybe take back promissory notes. We love to have grants, grant to retain annuity trusts, in which annuity payments going back could be property in kind, including interest and qualified opportunity funds. We love to exercise a power of substitution that allows us to swap in and swap out assets, and the IRS has blessed that and said that that's not going to be an estate tax includable event, and it's one of the grant or trust triggers written into Section 675 4C of the code. So what about those? We mentioned that in our comment letter. Treasury officials who were there said, you know what? We think it's implied that under principles of 85-13, that shouldn't be a problem. And I said, I completely agree, but it would be so helpful when a client comes to me and wants advice on this if we had something in the final regulations that said that very point. So hopefully that will be included. We will see. Just a couple other minor, I don't want to say minor, but time beckons, and I'm just going to just focus on a couple other points to be raised too. So fourthly, you could have a situation of someone is a partner in a partnership. The partnership tax return, including an LLC that's taxed as a partnership, it could also be a trust or estate or an S corporation. That income tax return goes on extension. And the extended return isn't due until maybe September, okay, of that same year. And a K-1 doesn't get issued until maybe September or thereabouts. What's the problem with that? Well, the problem with that is this. What the proposed regulations say, you have 180 days from either the day of the transaction or a deemed day of the transaction, quite often the partnership setting, that could be December 31st of the year, to go ahead and put the funds in that are basically a fungible amount equal to the capital gain that you have into the Qualified Opportunity Fund in order to qualify for the tax benefits. What happens if you don't get a K-1 until August or September? Bottom line is you don't even know about having the capital gain to invest in a Qualified Opportunity Fund until you are too late. So given that the purpose of the statute is to promote economic investment in opportunity zones, economically distressed communities, it would seem to be more consistent with the statute to allow some sort of relief so that this way, if someone doesn't, through no fault of their own, doesn't get word through the K-1 mechanism of this, that they are allowed some sort of extra time allotment. We'll see what Treasury does with that in the final regulations. And then finally, question of basis. Basis. It is such an important part of estate planning these days with higher exemptions. So much is focused on the income tax world. Well, I mentioned before, in the statute, you said when death occurs, Section 691 applies, income in respect of decedent. And under Section 1014C, there's no step up in basis for income in respect of decedent. So what does that mean practically here? It means that as to the deferred gain amount, there's no step up in basis. But what happens if there's been growth in the value of the Qualified Opportunity Fund from the initial point of investment in it until the point when the person who made the investment in it dies? At that point in time, income in respect of decedent principles say that the deferred gain amount, which was previously not taxed, will be taxed at that point in time. But what if there's been appreciation prior to the point of death? What about that? It seems that under the language of the statute, that should be eligible for a step up in basis, and we've asked for clarification as to that. So those are the points that we raised in our comment letter, some of the reactions we received informally from Treasury at the hearing, and it's been represented that we'll get final regulations later this year. So we shall see.
Thank you, Kevin, for providing us an update on the new area of qualified opportunity funds and opportunity zones.
Thank you for listening to this episode of ACTEC Trust and Estate Talk, the podcast about wealth planning matters from the American College of Trust and Estate Counsel. To find an ACTEC lawyer near you, visit actec.org. Please subscribe to this podcast and leave us a rating or a review at iTunes, Apple Podcasts, Stitcher, Google Play, or wherever you download your podcasts. Follow us on Facebook and Twitter at ACTEC Talk.